Welcome back to Iron Financial. This is the place where we help you forge a stronger portfolio by stress testing the market's weakest links. I'm your lead analyst, and today we're putting Flowers Foods, ticker FLO, on the anvil. Now, this company has been turning a lot of heads, looking like a high-yield steel beam that could support any income portfolio. But our job isn't to admire the blueprint. Our job is to take a sledgehammer to the foundation and see if it cracks under pressure. So let's get to it. Let's see if Flowers Foods is built to last or if it's a house of cards waiting for a breeze.
And this, right here, is the shiny object that's catching everyone's eye, an 8.7% dividend yield. In a market starved for returns, a number like this is practically screaming at you from the screen. For a lot of investors, this is where the research starts, and unfortunately, where it ends. They see a huge yield from a company that makes household names like Wonder Bread and Tasty Cake, and they think, how can I lose? It feels solid. It feels safe. But here at Iron Financial, we know that the bigger the yield, the harder you have to look for the cracks. The most tempting opportunities are often the most dangerous.
Whoa, pump the brakes, analyst. 8.7% from a bread company? Seriously? My internal alarms are blaring right now. That just screams too good to be true. You know, that's the kind of number that gets people into a lot of trouble. So before we even start talking about this as a steel beam, we need to ask the real question, is this a legitimate pillar of strength for a portfolio, or is this just a big, juicy piece of cheese on a mousetrap about to snap shut on unsuspecting investors? Because I've seen this story play out a dozen times, and it usually ends with a lot of people losing a lot of money. The foundation has to be inspected first.
You're absolutely right, Skeptic. And that's exactly what we're here to do. You want to stress test it? Let's go. But to do this right, we have to play devil's advocate. We have to build the bull case first, brick by brick, using the company's own numbers from their Q4 report. We're going to construct their argument, see how it looks, and then we're going to see if we can withstand a little bit of pressure. So let's dive into the numbers that have the bulls so excited and see what kind of story they're trying to tell us.
Okay, first brick in the wall. Earnings per share, or EPS. The company reported an adjusted EPS of 22 cents. Now, the so-called experts on Wall Street, the analysts, they were only expecting 16 cents. So Flowers Foods didn't just inch past expectations, they smashed them. They beat the consensus estimate by more than 37%. Now, on the street, a beat of that magnitude is a big deal. It's a signal flare to the market that says, hey, look over here. Management knows what they're doing, and this business is firing on all cylinders. At least that's the narrative they want you to believe.
And it's not just some clever accounting on the bottom line that's getting attention. Take a look at the top line, the revenue. Net sales clocked in at $1.23 billion. That's an 11% jump from the same quarter last year. Now let's put that in perspective. This is a company that sells bread. It's a mature, slow, and steady industry. Seeing double-digit revenue growth here is like seeing a tugboat win a speedboat race. It's highly unusual and, on the surface, incredibly impressive. This is the kind of strong top-line growth that's supposed to support a big, healthy dividend.
So how did they pull it off? Well, according to them, their big-name brands are doing the heavy lifting. Dave's Killer Bread, which is one of their premium, high-margin brands, saw its unit sales climb a solid 3%. That's not just price hikes, that's more people actually buying the product. They also say they grabbed more market share in important areas like breakfast breads and buns. And maybe the most important part of the bull case, management delivered. They finished the year at the high end of their own forecast. That builds confidence. It paints a picture of a well-oiled machine with powerful brands and a management team that executes. So there you have it, the bull case, all laid out. Looks pretty solid, right?
On paper. That's the key phrase right there, isn't it? Looks pretty solid. That's what the salesperson tells you. The bull case is always the glossy brochure with all the pretty pictures. Well, our job here at Iron Financial is to be the home inspector who kicks in the drywall to check for termites. It's time to take that shiny 11% growth number and see if it's a solid steel I-beam or just a piece of rotting wood with a fresh coat of paint. It's time for reality to bite back. Let's get our hands dirty.
And this, my friends, is where the whole beautiful story starts to crumble into dust. Let's take that big, impressive 11% growth number and break it down. You see that huge blue slice? 7.8% of that growth, the vast majority of it, came from an extra week in their fiscal calendar. It's not real growth. It's an accounting quirk, a trick of the calendar. Okay, now look at the orange slice. Another 4.7% came from an acquisition, Simple Mills. So again, they didn't earn that growth, they bought it. Now, when you strip away the calendar trick and the growth they bought, you're left with the green slice, the one that actually matters. That's their organic volume, the actual amount of bread and snacks they sold from their core business. It was negative. It went down by 2.2%.
Let me be absolutely 100% crystal clear about what that last slide means. The entire foundation of this company, its whole reason for existing, is to sell baked goods. And that foundation is actively shrinking. They're selling fewer loaves of bread, fewer buns, fewer of everything that is core to their business. That headline 11% growth number isn't just misleading, it's a mirage. And if you're an income investor looking for a safe place to park your cash, you need to understand this. The core engine of this business is running in reverse. This isn't just a crack in the foundation, it's a sinkhole opening up underneath the whole structure.
And hey, don't just take my word for it. You don't have to believe the skeptic. Let's hear from the man in charge, the captain of the ship himself, CEO Riles McMullian. Buried right there in the earnings report, he basically gave investors a written warning for what's coming next. He said, and I'm quoting directly, "We anticipate these category headwinds will result in financial performance below 2025 levels." The CEO is telling you in plain English that next year is going to be worse than this year. This isn't my opinion, this isn't speculation. This is a direct warning flare fired from the C-suite. They are telling you to brace for impact.
Exactly. The CEO's own weak forecast is the first major crack in the armor. But believe me, when we start digging into the rest of the financials, we find it's not the only one. It's not even the biggest one. The entire foundation of this company is showing serious signs of stress. So let's start shining a bright light on the other red flags, the ones that the glossy brochure conveniently leaves out, because the problems here run much, much deeper than just one bad forecast.
Let's start with this ugly number right here. Negative $136 million. That's a non-cash impairment charge they took this quarter. Now, non-cash might sound harmless, like it's just moving numbers around on a spreadsheet, but don't be fooled. This is a really big deal. This is the company's own accountants putting on the brakes and officially admitting that some of their assets, their own brands, are not worth what they've been telling you they're worth on the balance sheet. Think about that. They're basically admitting that parts of their business are decaying. What does it say about the future when your core assets are literally losing value right before your eyes?
And just so we're all on the same page, let's be technically precise. An impairment charge is a formal write-down. It happens when a company is forced to acknowledge that the future cash-generating ability of an asset is now lower than what they previously thought. It's not a guess, it's an admission. They look at a brand they own and have to say, you know what, we were wrong. This thing is not going to make as much money as we projected. In their own words, Flowers Foods said the long-term outlook for certain brands is lower than previously forecasted. This isn't a speed bump. This is a clear signal of underlying structural rot.
Wait. Are you kidding me? So let me see if I have this straight. In one breath, they're telling us their assets are worth less money, and in the next, we see that their debt has absolutely exploded. This is a textbook recipe for financial disaster. Look at these numbers. A year ago, their long-term debt was about $1 billion. Now, it has skyrocketed to almost $1.8 billion. That's a 74% increase in just 12 months. Most of that was to buy that Simple Mills growth we already exposed. This is like putting a new roof on your house with a credit card while you know the foundation is crumbling. It's reckless.
And the skeptic is not being overly dramatic. This metric right here proves the risk is real. Their net debt to trailing 12-month adjusted EBITDA ratio, which is a key measure of a company's ability to pay its debts, has now hit about 3.3 times. Let me give you some context. For a consumer staples company, that is high. We consider anything over the 3 times mark to be elevated leverage. This level of debt puts a financial straitjacket on the entire company. It severely limits their flexibility to invest, to innovate, and most importantly for this discussion, it puts that juicy dividend directly in the line of fire.
Okay, so let's just take a quick inventory here. The core business is selling less product. The value of their existing assets is being written down, and they've piled on a mountain of new debt. That is a seriously weak foundation. So that brings up the next logical question. What are the architects doing? You know, the people who designed and built this company, the insiders who have the most information. Are they buying more stock, showing confidence in a turnaround, or are they selling? There's an old saying on Wall Street, follow the money. Well, let's see which way it's flowing.
And here is your answer, clear as day. The architects are not just leaving the building, they're sprinting for the exits. Look at this. The CEO, Riles McMullian, the same guy on the conference call talking about headwinds, had his broker on the other line selling almost $7 million worth of his own stock. In the last 6 months, he has dumped nearly 560,000 shares. The chief human resources officer is selling too. Listen, when the senior executives, the people who know every single detail about the company's prospects, are cashing in their chips and heading for the door, you have to ask yourself one question. What do they know that I don't? Their actions are screaming, get out, even if their words aren't.
And if you think it's just a couple of execs taking some profits, you are dead wrong. It's not just the insiders. Look at what the real smart money is doing. The giant institutional funds with armies of analysts,
The ones who do this for a living, they aren't just selling. They are staging a full-scale exodus. T. Rowe Price unloaded 98% of their position. Cook and Beeler and Boston Trust Walden, they sold every single share they owned. They liquidated their entire stake. And Renaissance Technologies, one of the most sophisticated quantitative funds on the planet, slashed their position by almost half. These are the sharks in the market. And when all the sharks start swimming frantically in one direction, you do not want to be the lonely swimmer left behind. All of this, every single piece of evidence, brings us back to the central question. It brings us back to that siren song of an 8.7% dividend that got our attention in the first place. We've seen the foundation is shrinking, we've seen the cracks of impairment charges, we've seen the crushing weight of new debt, and we've watched the architects and the smart money flee the scene. So now it's time for the final stress test. With all of this immense pressure building up, can this structure possibly continue to support the massive weight of this dividend? And here it is, the number that blows the entire bull case to smithereens, 107.6%. That is their dividend payout ratio. Let me translate that for you. For every single dollar that Flowers Foods earns in profit, it is paying out $1 and almost 8 cents in dividends. This isn't just a little stretched. This isn't just unsustainable. This is pure financial insanity. A company cannot, by the laws of mathematics, pay out more money than it brings in forever. It's like trying to fill a bucket that has a giant hole in the bottom. The clock is ticking on this situation, and it's ticking very, very loudly.
Look, you don't need an MBA or a CFA to understand this slide. This is the final nail in the coffin for the dividend safety. The math here is simple, and it's completely unforgiving. On the left side, you have the promise. The company is committed to paying out 99 cents per share in dividends annually. On the right side, you have the reality. Their own guidance, their own forecast says they're only going to earn between 80 and 90 cents per share next year. It doesn't add up. Even in their best-case scenario, they will come up short. A dividend cut isn't just a possibility here, it's a mathematical certainty.
So, there you have it. We've laid out the bull case they presented. We took our stress test to the foundation. We've inspected every crack, followed the money flowing out, and run the final numbers. Now it's time to put all the evidence on the table and deliver the final iron financial verdict. Let's weigh it all up and come to a clear, actionable conclusion for your portfolio.
All right, let's put it all on the scales. In the bull's corner, holding up the foundation of strength, you have, what? A headline EPS number that we've already proven is a mirage, and some legitimate strength in one of their premium brands. That's it? Now, in the bear's corner, under structural weaknesses, the list is staggering. The core business is shrinking, they're admitting their assets are worth less, debt is ballooning out of control, the CEO and the biggest funds in the world are selling as fast as they can, the dividend payout is mathematically impossible to maintain, and the company's own guidance is screaming for a rough year ahead. This isn't a balanced debate. This is a landslide. It's an avalanche of negative evidence.
So the verdict here at Iron Financial is unequivocal. Flowers Foods is a classic textbook yield trap. That beautiful 8.7% yield isn't a sign of a strong, healthy company. It's the bait, designed to lure you in before the structure gives way. The foundation is crumbling, the balance sheet is under extreme pressure, and the people who know the most are already gone. So we leave you with one final question to consider. With a crumbling foundation and the architects fleeing the building, is an 8.7% yield really worth the risk of a total collapse? The choice, as always, is yours. Thanks for joining us at Iron Financial, where we help you forge a stronger portfolio. We'll see you on the next one.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.